Right now, China's property market is sending out some really conflicting signals. On one hand, you have prime cities showing incredible resilience. But on the other, the broader market is still grappling with massive inventory and debt. So today, we're breaking down this critical divergence and what looks like an unprecedented policy response from the government.
So let's start with the conclusion right up front. The data we're seeing for September 2025 reveals a market that isn't just one single story anymore. It's actually fracturing. It's splitting into two very distinct and diverging paths.
To really get our heads around this divergence, our analysis is going to move through 5 key areas. We'll kick off with a high-level market overview, then we'll uncover the core story of this split. After that, we'll examine the structural headwinds holding things back, assess the wider macroeconomic impact, and finally, we'll analyze the policy response that's taking shape. Okay, first up, let's establish the overall condition of the market. The latest figures from the National Bureau of Statistics paint a picture of really sharp contrasts where it looks like the market is trying to find a floor. This slide highlights a really crucial dynamic. You see, on one hand, the month-over-month data, so the change from August to September, that still looks pretty weak. It reflects soft buyer sentiment right now. But on the other hand, the year-over-year decline, which compares prices to last September, is actually slowing down, and that's a key signal. It tells us the most acute phase of the price correction might be passing as the market starts to form a base. So this brings us right to the central theme that's emerging from all this data: an unprecedented divergence between cities. It's creating what you can only really describe as two parallel property markets. And you can see this split so clearly in the new home prices. You've got these resilient core markets like Shanghai posting strong year-over-year growth of 5.6%. But then, in sharp contrast, other top-tier cities like Shenzhen are still seeing declines. This is definitely not a uniform market recovery. Now, what's really interesting here is the granular detail this matrix gives us. Just look at the exceptional strength in Shanghai's market for large homes, up a full 7% year-over-year. That points to very resilient demand from high-net-worth buyers. Now, compare that to the broad weakness down in Guangzhou, and notice the pressure on used homes pretty much everywhere. That signals a significant amount of existing inventory is up for sale. So what's driving this? Well, the underlying driver appears to be a capital reallocation trend. Amid this broader economic uncertainty, domestic capital is concentrating in what it perceives as the safest, most liquid property assets. This is less about speculation and it's much more about wealth preservation. And that's creating these resilient islands in an otherwise pretty weak market. So, the big question is, why isn't the entire market recovering? Let's take a look at the 3 key structural headwinds that are really constraining a broader, more uniform recovery. First up, and this is a big one, a persistent inventory overhang, a national clearance cycle of over 23 months. That means supply is still significantly outstripping demand, and that's going to require a long, prolonged period for the market to rebalance, putting constant downward pressure on prices in most regions. Second, household leverage is high. With the household debt to GDP ratio sitting at 61.1%, consumers are really focused on deleveraging. We're even seeing a trend of early mortgage repayments, which indicates a shift towards risk aversion. And that, of course, limits the capacity of the household sector to drive new demand. And third, developer debt. With over ½ trillion yuan in debt maturing this year, developers, especially private firms, are facing continuous refinancing pressure. This restricts their ability to invest, and it also negatively impacts market confidence, creating a really challenging feedback loop. Now, of course, these property market dynamics aren't happening in a vacuum. They're creating a difficult feedback loop for the wider economy, and that presents a complex dilemma for policymakers. So here's the crucial point: this divergence in inflation. The property slowdown is the primary anchor dragging down overall headline inflation. But at the same time, you have this resilient core inflation, which is driven by the services sector. And that limits the central bank's scope for aggressive, broad-based monetary stimulus without risking overheating in other parts of the economy. And the property downturn's drag, well, it extends right across the economy. It's a significant brake on investment and construction, it suppresses industrial prices, and through negative wealth effects, it weakens demand for consumer durables like furniture and appliances. In response to all these complex challenges, the focus of government policy appears to be undergoing a pretty significant strategic shift. It looks like it's moving away from broad-based demand stimulus and toward a more direct approach to that inventory problem. So, the policy toolkit is evolving. We're observing a strategic pivot here. Earlier easing policies, they really acted as a demand multiplier, which was only effective in markets where there was already pent-up demand. This new approach, though, it's a pragmatic strategy of direct intervention. It's aimed at actively reducing inventory and stabilizing the market from the supply side. All right, so to bring this all together, China's property market is undergoing a fundamental structural shift, one defined by deep divergence. You've got these powerful headwinds like high inventory and leverage that are constraining recovery, and that's creating a complex dilemma for policymakers. In response, policy is now pivoting away from simply stimulating demand and towards directly managing supply. And this leads us to the final forward-looking question. As the state takes a more direct role in purchasing and managing housing inventory, what are the long-term consequences going to be? How will this reshape market structure, private sector participation, and the fundamental mechanisms of price formation in China's property sector?